Early on, I knew that if I had one objective in my life, it was to never be poor again. And I just knew that I was going to do everything in my power to achieve that.
Meet Genesis. She's a 27-year-old business analyst at a big tech company. She lives in Boulder, Colorado with her husband and toddler. She's very proud of how far she's come and isn't shy about sharing her family's struggles growing up.
I grew up in Virginia with a single mom of 3 kids. My mom immigrated from Bolivia. We kind of had to figure things out for food. Like, I remember one of my favorite snacks were canned peaches. We typically wouldn't buy those on our own. They would be from donations. But I remember just wanting to put 10 cans of peaches on our little order slip.
Even as a kid, Genesis was aware of how much her mother struggled to make ends meet.
I remember my mom coming home late one evening from one of her jobs. I remember just peeking through, essentially it was like a makeshift bedroom. There were bills on the table and seeing her sifting through documents and having her head in her hands. I didn't know why, but I just felt that tension, that stress that she was experiencing. There was often a lot of arguing because we didn't have those basic needs met, as in, we had a few rooms in a basement apartment, but we knew that we suffered from a low income.
Genesis worked hard to become the first in her family to go to college, and it's paid off. She has a budding career at a well-known tech company. She owns 2 properties that provide some additional cash flow. And she began documenting her money journey on social media and now earns additional income as a content creator. But it's a lot to juggle.
I recently took a hiatus for 6 weeks in Bolivia because it became a lot. And I was suffering from a lot of anxiety because if I was at home, I was thinking about work. If I was at work, I was thinking about content. If I was thinking about content, I was thinking about my son. And so eventually your mind can't really hold that much information. And so it's a lot. And I'm so grateful that I've hustled so strongly for the last 4 years.
There's a reason Genesis has been hustling so hard. She has a big goal in mind.
I'm on social media, right? And I'm scrolling, and I see some people that shared their net worth stories. And year over year, they doubled it, 250 to 500 to a million, right? And if they can do it, why can't I? Immediately, I was like, okay, I currently have $500,000 net worth, which I'm really proud of, but I want to double it this year.
And that's where we'll start today. I'm Jamie Rowe, and welcome to What Should I Do With My Money, an original podcast from Morgan Stanley. We match real people asking real questions about their money with experienced financial advisors. Here at Morgan Stanley, we work with a range of clients. Some are experienced investors, others are new to working with a financial advisor. On this show, you get a front row seat to hear what these initial conversations are like and get answers to some of the questions you might have yourself. Genesis is the primary breadwinner in her family and works several jobs. She's built up a net worth of about $500,000 and has set a goal to double it in a year's time. She's considering all her options, maximizing her savings, increasing the income from her side hustles, and maybe just smarter investing. But what's the best way to fit all these pieces together? Will it be enough to help her reach her ultimate goal of buying a dream home? And what kind of guidance does Genesis need to achieve her goals? To help Genesis level up her financial knowledge, we have Era, a first vice president and a financial advisor at Morgan Stanley. She says her approach to financial planning is inspired by her first career as a collegiate athlete.
I've played sports my entire life, and I had played Division I college basketball. And as an athlete, I had always been very goal-oriented. Now, in my role as a financial advisor, I actually equate it to athletics, where I consider myself a financial coach. I help my clients put together financial game plans, and we track progress, and we set goals, and all of these kind of experiences that you have in athletics really do correlate into financial planning.
The more she found out about the world of wealth management, the more she saw similarities to the leadership skills she'd learned on the court.
I was not the best player on the team and had to fight really hard and earn my spot. And ultimately, as a junior, was asked to be a captain even though I wasn't starting. It taught me that it's not just about if I can hit shots. It's about my ability to communicate with my team, to be a team player, to be a leader.
Many of Era's clients are young professionals like Genesis, who are at the start of their wealth journey.
I work with a lot of individuals that work at tech companies and have equity compensation as a large part of their wealth. We also work with some founders, some athletes, but many of our clients are kind of that next generation trying to build their wealth in different ways.
Well, Era, I think you're the perfect fit for Genesis, so I'm going to turn it over to you.
Thanks, Jamie, and thanks, Genesis, for having this chat with me today. I'm so excited to talk to you.
Yes, I'm excited too. I have lots of questions for you.
Oh boy, we'll get right into it because the time is yours.
Okay. I want to double my net worth, right? Basically, imagine it's 500,000 and I just want to double that sucker. How can I do that? I know that I will have to increase my income. That's a given. But what can I do with my investments in order to achieve that goal or at least get me closer?
Well, with just your investments, it will be very challenging to do that in 1 year. And honestly, it's probably not going to happen just with investments. That is a very, very, very short time horizon to double your money.
So there's a couple of things that we think about when it comes to doubling your money. And the first just kind of little secret I want to share is about the rule of 72. Now, this doesn't exactly apply to your situation because we only have a 1-year timeline for this. But for everyone else, the rule of 72 essentially tells you how long it's going to take you to double your money with a given rate of return. So you use the number 72 and divide it by your rate. So in this case, let's just say 6%. And that will give you an approximate number of years that it'll take to double your money. So if we said, okay, 6%, 72 divided by 6%, 12 years to double your money.
So someone might think 6%. I can do better than that. But what's good to know is that the average annual return of the stock market, measured by the S&P 500 index over the long run, is about 10%. A little less when adjusted for inflation. So using this as a proxy for reasonable expectations of market returns, it would take a little over 7 years. Now, for a 1-year time horizon, it's even harder to predict because in 1-year periods, the market can provide returns that are much higher or much lower, even negative.
So instead, if our goal is to double our money, we need to think about all the other little things that we do every day to help grow our net worth. So things like saving more, spending less, and making more money, those are things that are actually going to help increase that total net worth.
Okay, that's helpful.
And then we might want to focus on other things like your forced savings. And what I mean by forced savings is utilizing things such as your 401k. So investing as much as possible into your 401k, especially if your employer has a match. And then additionally, if your employer offers things like mega backdoor Roth options, taking advantage of those within your employer.
Okay, mega backdoor Roth. Stay with me. A regular Roth IRA or Roth 401k is a different flavor of an IRA or 401k. As you may know, traditional IRAs and 401ks are retirement accounts that allow you to make tax-deductible contributions for IRAs or before-tax contributions from your paycheck for 401ks, up to a certain limit. The earnings grow tax-free, but then the distributions are taxed as ordinary income when you make withdrawals in retirement. With a Roth 401k or IRA, you make after-tax contributions, and the earnings grow tax-free, but then the distributions do not get taxed as income when you withdraw in retirement if you meet the requirements for a qualified distribution. However, there are income limitations to who's allowed to invest in a Roth IRA and limits to how much you can contribute to both Roth IRA and Roth 401k. In 2024, The 401k limit is $23,000 if you're under 50, and if you're over 50, it's $30,500. For IRAs, the 2024 limit is $7,000 or $8,000 if you're over 50. So, hopefully you're still with me. A mega backdoor Roth is a strategy available at some companies to enable people who reach the regular 401k contribution limits to make contributions to their traditional 401k on top of the usual limits on an after-tax basis, and either convert them to a Roth 401k within the same plan or roll them over into a Roth IRA. There are two reasons some people do this. One reason is that you can make additional contributions to your retirement account beyond the limits I mentioned before. For 2024, total contributions are capped at $69,000. If you're 50 or older, the limit is $76,500. This amount includes all contributions to your retirement accounts, including any company match. The other reason people do this is that you can enjoy the benefit of a Roth account where your withdrawals are tax-free during retirement. Obviously, this is complicated, and there are other nuances to it too, including potential tax implications. So it's best to discuss the options with your tax advisor to see what's right for you.
Additionally, if your employer has an ESPP program or an employee share purchase program, that's another great way to do forced savings from your paycheck. Not only do you get the benefit of after-tax savings, but most companies also buy the shares for you at a discounted price. And then also just automating. Automating is an amazing tool where all of a sudden you look at your accounts and you've accumulated all this wealth that you now have to figure out how to invest into things. And that money is just going to continue to compound and make you more money.
I like the way that it sounds like forced savings. Is that the actual name for it?
That's what I call it. When your savings are out of sight and out of mind, you don't even think about it. And the only time you would really start to worry about it is if you had additional cash flow needs. And then we'd say, okay, where are areas we should adjust to ensure we have enough cash flow to meet our day-to-day needs?
I love that. How can I avoid becoming emotionally attached to an investment? Things like stocks, real estate, whatever it may be.
Money is emotional. It is very personal, and people tie money to their life events, their families. We have clients that they've inherited stock from their grandfather 20 years ago, and they just won't sell because their grandfather gave it to them. And there's kind of the logical thing to do in some cases, but then there's always going to be that emotional aspect. And that's actually one of the benefits of working with a financial advisor. We can help you take the emotion out of some of these decisions and focus on your financial goals.
Era boils it down to risk tolerance versus risk capacity.
So risk tolerance is the amount of risk you're comfortable taking. If it comes down to emotions, when you say, I don't care what happens to this stock, my grandfather gave it to me, I'm holding it no matter what, you're going to feel a little bit more tolerant about how that particular stock moves. But let's say that you have to put your kid into college, and we are doing that in 18 years. There might be a change in the allocation that has to happen. And that's what our risk capacity is. It's the amount of risk that we have to take in order to achieve those goals. And so there is a conversation that's had about what's more important to you. Is it the emotional need to have this stock for a personal reason, or do I want to reach this other goal?
Speaking of goals, especially stretch goals, Genesis knows exactly what she wants to put her money toward.
Really, my financial goal is to afford this $3 million house in Boulder, Colorado. My husband and I, we'd go on walks. And this house, when we were walking with our 3-month-old, it piqued my interest. And I looked at it and I was like, that's the house that I want. I looked it up on Zillow and I fell in love with it even more. It has 2 in-law suites in there. I also want to have the ability to be able to host my family members, my mom, whenever she gets of age, or my siblings, if they ever want to move in with me. So I do have this desire to have my family with me. My goal is to buy this house by the time I'm 30. I have 3 years.
Okay.
If that's the goal that I want, how much do I have to make per year in order to actually afford it? Because sometimes we talk about like affordability. Oh yeah, I can afford that.
Right.
But it shouldn't be like 80% of your income.
Yeah, well, the home sounds lovely, but there are a couple of things to consider when we think about buying a house. And the first thing is how much you can actually afford to put down. So on a $3 million home, generally we would consider putting down 20%, so about $600,000. Then we actually need to determine what is a comfortable monthly payment from a cash flow perspective. That monthly payment also has to take into account your mortgage, your insurance, your property tax, your maintenance. And that might end up being a number that is beyond your current income.
Okay.
In order to make this home purchase possible, Genesis has a lot of things to think about. Where will her down payment come from? What does her income need to be to afford the monthly carrying costs of that home? Key to all of this will be for Genesis to decide if that dream home is a realistic goal in the next few years, if she also wants to stick to her other financial goals.
The general rule of thumb would be not to spend more than 28% per month of your income on your housing. I think now, given inflation and changes in the cost of real estate, it's probably closer to 30 or 35%.
That's helpful. I like the percentages. When I can do that, I'll be able to maybe say, yes, I accomplished that, because that easily allows people to just like quickly calculate and be like, okay, am I good or am I bad, right? So that's really helpful.
Genesis also wants to ask about the equity she has at work. Her company stock has been doing well, but she knows she could be doing more with it.
I recently had a conversation with a coworker, and I told them how much I had in my tech company's equity. And they were like, oh my gosh, I can't believe you've held on to it since you started your job 4 years ago. And thankfully, it has performed well. So for the sake of just rounding down, I'm going to say I have $100K in my tech company, and I don't know what to do with it. I imagine I am not very well diversified, and I would like to be. What would you do with this money?
So the general rule of thumb when it comes to financial planning is to not have more than 20% of your net worth in one individual stock. However, my team, having specialized in working with individuals that have equity compensation, we have absolutely seen what concentration can do. So we usually like to say that concentration can create wealth, but diversification can preserve it. It just depends on your risk tolerance and how comfortable you are with volatility. Some companies that have been around a really long time and have grown at pretty consistent rates, those are a lot of the companies that our clients, they feel a little bit more comfortable holding more concentration versus maybe some newer companies where the verdict's still out on if that's going to go up or down. Another thing I'll note is a lot of times with concentrated positions, our clients consider this a forced savings. So you continue to save that money, save that money, save that money. And then when it comes time to diversify, they don't know what to do. And in a lot of cases, we might have a low cost basis.
Low cost basis means there's a large gap between the price you paid to acquire a stock and the actual value the stock is trading at in the market, or the valuation of the stock if it's a private company. This is often the case in equity compensation plans if an employee is given company stock at a reduced price.
We have to be really aware of the fact that if we sell, we're also going to have a potential capital gain. So keeping in mind what your tax situation looks like is also important when it comes to diversification.
That's really helpful. What's interesting too about that actually that I find extremely valuable in this conversation is I pay tithing. I'm Christian. And that is a huge way to pay tithing with your stock in order to reduce your capital gains tax. That's something that I'm focused on this year. Typically, I would pay it with my paycheck every single pay cycle. And now I'm not, which is nice because I basically have more money, but also because I'm reducing my my capital gains tax.
Absolutely. I mean, a great way to think about any type of charitable gifting is to use your low basis stock because of the potential for additional deductions, and having those conversations with your tax advisor to maximize those deductions is a great next conversation.
Perfect. Thank you. That's really helpful. From what you know of what my finances are like, do you have any advice for me of where I could educate myself on, like different investments, or just in general of areas that I can improve my own finances?
So I think the first thing I would do is put together your A team. And when I say A team, I mean your accountant, your attorney, and your advisor. That's important, especially when you have multiple side hustles, because there might be potential for tax deductions that you're not familiar with. There might be entities you want to set up that an accountant or attorney can advise on. And having those three people in your corner can really put you in a good position for success.
Super helpful. I would say that probably one of the first questions that anyone has when even considering a financial advisor is to know, when is it time to get one? And so that's my question for you.
Great question. I like to say that we manage money for people that are unwilling, uninterested, or unable to do so. And that is kind of broad, so I'll break that down a little bit more. Someone like yourself, where you are really interested in doing it and you enjoy doing it, a financial advisor might help you in other areas, such as estate planning or insurance planning. But once you continue to grow and grow in your career, you might enjoy it, but you might not have the time. And having to delegate some of those duties to an advisor, such as portfolio management or financial planning, can help you excel at what you do in your job and in your side hustles.
That's really helpful. When I'm looking at my finances, I realize I'm just trying to save and invest as much as possible. But for me, like, what is the best way for me to know if I'm on the right track? And obviously this depends on your goals, right?
Yeah, of course.
But like, I don't even know. I don't know how to decide, oh yeah, you're doing great, Genesis.
It's tough. I think the definition of success has to be flexible. One of the things that I look at, especially with my equity compensation clients where we do have a concentrated position, is if the stock went down 20%, 40%, 60%, how would you feel? And if the stock went up 20%, 40%, 60%, how would you feel? The same thing about our net worth. If your net worth doubled, how would that make you feel? And how much would your life change? But how would you feel if it got cut in half? And how much would that affect your day-to-day? And I think once you get to the point where if your net worth gets cut in half, and you're still going to be okay and be able to reach your goals, I think that's a good measure of feeling like you've been successful.
That's helpful. Truthfully, I almost see it as like financial therapy. It's like, that's what a therapist does, you know?
I want to bring it back to my days as an athlete and talk about making sure that we've practiced enough to where we're actually ready for the game. When we have a financial goal, it's not just going to happen overnight. It usually takes work and a game plan. It takes action, and we have to be able to track those actions and make sure that they are adding to our progress and ultimately our goal. A great place to start would actually be with putting together a game plan, putting that financial plan in place to track our progress and really see where we need to decrease spending, increase savings, or adjust our asset allocation. That will really help us be in the best position possible for success.
Well, Era, thank you for your guidance today. You provided a straightforward framework for how to increase your net worth, set up for savings, determine the affordability of a home. All very helpful.
Thank you, Jamie, for having me. And Genesis, thanks so much for the conversation.
Yes, absolutely. You were extremely helpful, and I feel like I have a really good guideline of where to go next. Thank you.
So, Genesis, was there anything surprising in the guidance Era shared with you today?
The mega backdoor Roth investment into my 401k was something that I haven't necessarily explored in the past. And so that's definitely something that I'm going to explore.
Are there any other things you're going to explore based on what Era told you today?
Yes, I want to see how much money do I need to make in order for my $3.2 million house to not exceed the 28% rule to buy real estate.
That was helpful, right?
Yes, it is, right? Because we often have these goals, and I'd say you need to have the mini goals in order for them to actually be attainable.
Do you feel differently about your finances in any way?
Coming into it, I wasn't sure, like, am I doing well? Like the numbers say I'm doing well. But after the conversation, I'm feeling more confident and just eager to keep on learning.
Well, it was a pleasure having you on today, Genesis. Thank you for coming on and being so forthcoming about your situation and your goals.
Yes, absolutely. Thank you so much for having me. Seriously, a pleasure to talk to a financial advisor and to have it recorded.
If you'd like a deeper dive on what was discussed today, if you'd like to learn about our spending and budgeting tools, or if you're interested in having a financial plan done for you, come see us at morganstanley.com/mymoney. I'm Jamie Rowe. Talk to you soon.
For general reference and educational purposes only, the information provided herein is not intended to address any particular matter and may not apply depending on the context, as all clients' circumstances are unique. No legal, tax, or other advice is being offered herein. When Morgan Stanley Smith Barney LLC, its affiliates, and Morgan Stanley Financial Advisors and Private Wealth Advisors, collectively Morgan Stanley, provide investment advice regarding a retirement or welfare benefit plan account, an individual retirement account, or a Coverdell Education Savings account, retirement account. Morgan Stanley is a fiduciary as those terms are defined under the Employee Retirement Income Security Act of 1974 as amended, ERISA, and or the Internal Revenue Code of 1986. The Code, as applicable. When Morgan Stanley provides investment education, takes orders on an unsolicited basis, or otherwise does not provide investment advice, Morgan Stanley will not be considered a fiduciary under ERISA and or the Code. For more information regarding Morgan Stanley's role with respect to a retirement account, please visit www.morganstanley.com/disclosures/DOL. Tax laws are complex and subject to change. Morgan Stanley does not provide tax or legal advice. Individuals are encouraged to consult their tax and legal advisors, A, before establishing a retirement account, and B, regarding any potential tax, ERISA, and related consequences of any investments or other transactions made with respect to a retirement account. Past performance is no guarantee of future results. Estimates of future performance are based on assumptions that may not be realized. This material is not a solicitation of any offer to buy or sell any security or other financial instrument or to participate in any trading strategy. Diversification does not guarantee a profit or protect against loss in a declining financial market. The proceeds from a mortgage/home equity line of credit or non-purpose securities-based loan may not be used to purchase, trade, or carry margin stock or securities or repay margin debt, and cannot be deposited into a Morgan Stanley Smith Barney LLC or other brokerage account. Morgan Stanley Smith Barney LLC and its affiliates and their employees, including financial advisors and private wealth advisors, are not in the business of providing tax or legal advice. These materials and any statements contained herein should not be construed as tax or legal advice. Individuals should consult their personal tax advisor or attorney for matters involving taxation and tax planning, and their attorney for matters involving personal trusts and estate planning. Morgan Stanley Smith Barney LLC is a registered broker/dealer, member SIPC, and not a bank. Where appropriate, Morgan Stanley Smith Barney LLC has entered into arrangements with banks and other third parties to assist in offering certain banking-related products and services. Investment, insurance, and annuity products offered through Morgan Stanley Smith Barney LLC are not FDIC insured, may lose value, not bank guaranteed, not a bank deposit, not insured by any federal government agency.